Hello, everyone, and welcome to Chapter 7. Last time, we wrapped up our discussion on inventory, diving deep into how businesses manage and value their goods. Today, we're shifting gears to an equally, if not more, critical topic for any organization: fraud, internal control, and cash. This chapter is absolutely crucial because it addresses how businesses protect their most vulnerable asset, cash, and build trustworthy financial systems. We'll start by defining what fraud is in a business context. Essentially, a dishonest act by an employee that results in personal benefit at the employer's expense. A key concept here is the fraud triangle, which highlights three factors that commonly contribute to fraudulent activity. These factors are opportunity, which occurs when the workplace lacks sufficient controls to deter and detect fraud; financial pressure, which can stem from personal financial problems or a desire for a lifestyle beyond one's salary; and rationalization, where employees believe their dishonest actions are justified. You'll also learn about the Sarbanes-Oxley Act, or SOX. This landmark legislation, enacted in the early 2000s after major corporate scandals, applies to publicly traded U.S. corporations. It mandates that these companies maintain robust internal control systems, with corporate executives and boards directly responsible for their reliability and effectiveness. SOX also requires independent outside auditors to attest to the adequacy of these systems, boosting confidence in financial reporting. So, what exactly are internal controls? They are the integrated processes designed to provide reasonable assurance that a company can achieve its various objectives related to operations, financial reporting, and compliance with laws and regulations. Their main purposes are multifaceted. First, they help safeguard assets. Second, they enhance the reliability of accounting records, making sure the numbers you see are accurate and trustworthy. Third, they contribute to increasing the overall efficiency of operations, streamlining how things get done. And finally, they are crucial for ensuring compliance with all applicable laws and regulations. The sources highlight several principles of internal control activities that form the backbone of a strong control system. First, we have the establishment of responsibility. This means assigning tasks to specific employees and ensuring that for a given task, only one person is truly responsible. This clear accountability is vital. Next is the crucial principle of segregation of duties. This is where different individuals are responsible for related activities. Even more importantly, the responsibility for record keeping for an asset should always be separate from the physical custody of that asset. This significantly reduces the likelihood of fraud, especially when it comes to cash and inventories. Documentation procedures are also key. This involves using pre-numbered documents and ensuring that all documents are accounted for. This prevents omissions or double recording, maintaining an accurate trail of transactions. Then there are physical controls. These are the measures put in place to safeguard assets. Think of things like locked mailrooms, safes for cash, or secure computer systems protected by strong password policies. Independent internal verification involves having an independent employee periodically review data and report any discrepancies directly to management. This adds another layer of scrutiny and helps catch errors or irregularities. Finally, we have human resource controls. These are practices such as bonding employees who handle cash, rotating employee duties, requiring mandatory vacations, and conducting thorough background checks. All of these are vital for both deterring and detecting fraud within an organization. While internal controls are undeniably powerful and essential, it's really important to remember their limitations. They're designed to provide reasonable assurance, not absolute, that a company achieves its objectives. This is because they are always affected by the human element. Employees can experience fatigue or carelessness, leading to mistakes. Controls can also be circumvented through collusion, where two or more employees work together to commit fraud. And finally, a crucial consideration is that the cost of implementing a control should never exceed its benefits. Finding that balance is key to effective and efficient internal control system. Now, let's turn our attention to cash because effective internal control is particularly vital when it comes to this asset. Cash is without a doubt the most susceptible asset to fraudulent activities. Why? Because it's easily convertible, readily concealed, and can be transported with ease, making it a prime target for misuse. We'll explore various controls for both cash receipts and cash disbursements. For cash receipts, this includes practical measures like using cash registers for over the counter sales, ensuring proper assignment of responsibility for electronic receipts, and having daily deposits. When it comes to cash disbursements, paying by check or electronic funds transfer is generally far more effective and traceable than using actual cash. A key control system we'll examine is the voucher system, which involves a network of approvals needed before any disbursement is made, ensuring every payment is proper and fully accounted for. We'll also look at the petty cash fund, which is a small, designated amount of cash used for minor, impractical payments where using a check isn't feasible. A major control feature involves using a bank account. Banks serve multiple crucial roles. They safeguard a company's cash, they minimize the need for a company to hold large amounts of physical currency on its premises, and they create a vital double record of transactions, one by the business itself and one by the bank. This dual record leads us directly to the bank reconciliation, a fundamental process. The purpose of a bank reconciliation is to systematically compare the bank's balance for a company's account with the company's own cash balance in its books. This comparison helps to identify and explain any differences between the two, ultimately allowing us to arrive at the true cash balance. Differences typically arise from things like deposits in transit, outstanding checks, or errors made by either the bank or the company. Understanding how to perform this reconciliation is an absolutely fundamental skill in managing cash. Finally, we'll discuss how cash is presented on financial statements and dive into the basic principles of effective cash management. On the balance sheet, cash and cash equivalents, which are short term, highly liquid investments that are readily convertible to cash, are typically reported as the first current asset, signaling their immediate availability. We'll also look at restricted cash, which isn't available for general use and is reported separately to provide clarity. Effective cash management is all about ensuring a company has enough cash to meet its obligations while minimizing the amount of idle cash, which isn't generating revenue. This involves several key principles: increasing the speed at which receivables are collected, keeping inventory levels low to avoid tying up excessive cash, carefully monitoring the payment of liabilities to ensure they're paid on time but not too early, planning the timing of major expenditures when excess cash is available, and wisely investing any idle cash in highly liquid, risk free investments. A crucial tool for this planning is the cash budget, which shows anticipated cash flows and helps a company foresee potential shortfalls or identify investment opportunities. This chapter provides an invaluable framework for understanding how businesses safeguard their assets and maintain financial integrity. It's a foundational topic that you'll see applied in many real world scenarios. Next time, we'll move on to reporting and analyzing receivables, building on our understanding of how businesses manage the money owed to them. Thank you for tuning in, and we look forward to continuing our journey through accounting.